Sponsored by Anthony Mendez.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm the great Gordon Hines.
Great Gordon Hines. In the house today.
After a hiatus.
Where'd you go last week?
That's right. I traveled to Albuquerque.
Albuquerque. Yeah. You have properties there, don't you?
Yeah. And the week before that, I was traveling nowhere. The week before that was July 4th.
No, you had a charity event that you went to the previous Thursday. I remember that because I did the show and.
Yeah.
No, it was 4th. Wasn't it 4th of July? 4th of July. So Thursdays, we have a weird show because on Thursdays it happens on the seminars that we do with Rob Black.
Thanksgiving,
and then this year was 4th of July, and who knows? It'll be next year Thanksgiving as well. With that said, you can call the show 800-516-1220. We are live today, unless this is a recording, right?
It's not.
It's not a
recording. This is not Memorex. This is the real McCoy.
I fear that's the show that they play when we can't do it is the show that I go, hey, we're live, 100% guaranteed. It is a call-in show though. 800-516-1220. If you want to test it, call the show and they'll tell us. We'll get you on there. 800-516-1220. 800-516-1220. You can email the show, and we got a couple of emails today that we're going to hit. Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Emails are kind of our lifeline with the people out there. We get a ton of them. We love answering questions and scenarios. And we got a lot of them, Gordon, when rates dropped. 3 weeks ago, we saw the lowest rates we've seen in 3 years. They've bumped back up a little bit, but still well below, that average that we saw over the last couple of years, over 4%. Now we're below 4%. Freddie Mac has the 30-year fixed at 3.81%, the 15-year at 3.23%, and the 5-year ARM at 3.48%. And it depends on your equity, your credit score, and you could be below that, or you could be higher than that. We've seen a lot of people go, we want to get some cash out, or we want to pay off that equity line, because even though we're thinking that the Fed could drop the rate as much as a half a point, which could directly affect your equity line, your credit cards, car loans, so on. They still want to get rid of it because right now 30-year fixed rates, even on a cash-out loan, can be below the equity line rates and possibly even lower than the rate you have already on your first loan. So it's starting to make a lot more sense. We talked about this last week. I don't want to keep pounding it, but that's what these rates give people. Well, and that's all the scenarios we're getting.
It's not pounding, as Prince would say. It's a sign of the times. The Fed is poised for some type of rate increase.
Decrease.
All the leading economic indicators are pointing that's going to happen for the next 30 days. Some people are boasting it's going to be a half a point adjustment. Some people it's going to be standard 0.25%. But either way, it's going to be a better change in the marketplace as far as rates concerned. But typically what happens is before the rate actually happens, the cat's out the bag, the market already is poised for it. So a lot of times is when you hear the rate drop announcement, people call and says, well, that's what the rates were last week, because the market knew the rates adjustment was coming and they already penciled it in. So that's what happens a lot of times.
Think of this scenario too. This is coming from some of the mortgage experts that are out there saying that this one guy, he says, I like locking right now instead of floating because it seems that the 50 basis point cut that the Fed is expecting to do, it's already baked in. But if they only cut it a quarter, we could actually see rates go in the other direction. So, we were trying to do a refinance for Rob Black. He just happened to be out of town kind of that day that everything dipped. We priced it out for him, and Rob said, I got to think about it. I got to talk about it with, the other people involved. And next thing you know, the rates went back up. So these opportunities will present themselves. But, people are going to say, oh, the Fed's going to drop rates. It's already baked in. You just talked about that. Sometimes when they don't quite meet the expectations of that rate drop, in this case, that news, we might actually see rates go up. And I'm not trying to scare people into making the move, but you got to be, if you're going to make the move, this is a tough time of the year. This is like the worst time a great rate cut or rate drop on mortgage rates would come is when everybody's on vacation. But, spend some time. Most of the stuff people do nowadays is mobile. Get on the phone, just call them up, call us up, email us, and we'll write you the scenario. It doesn't take that long to get you into the system and push a button.
Well, every time we talk about rates, I always say rates are actually time stamped. Please don't try to time the market to try to get the rate at the lowest point, because it's very difficult to do, even as mortgage professionals that we are. So we always tell you, if there's a rate that you can work with, that you can live with, lock it, take it, and run. Don't just try to be greedy. Of course, greed causes a lot of defaults in our life. And when you try to get greed, get that lowest possible rate, end up costing you money. So the rate hits that pinnacle, lock it and take it and run.
I agree. You're welcome to call the show 800-516-1220, 800-516-1220. We're 10 years into our recovery, Gordon, 120 months of recovery. I'm sorry, 120 months. That's 10 years. A lot has happened. We've seen the market in the last 20 years. In fact, this survey only goes back to 1999, where we've seen the housing market distress at the lowest we've ever seen. Because they only go back to 99. They say it's entirely possible that that there is more time that it's been lower beyond 1999, according to CoreLogic. But the aftermath of the housing crisis, with the lenders and regulators clamping down, it's hard to make sure, figure out if there's going to be another bubble, because we do have these kind of really strict guidelines. I mean, one of the indicators that we watch that leads towards some sort of correction in the housing market is defaults, and we're at the lowest we are right now. And with Dodd-Frank and the qualified mortgages and the strict lending guidelines in general that are out there, I don't think we're going to see another recession like that we saw in the housing market part of it.
Well, let me ask you this: do you like to brag?
Of course I do.
Okay, we should be bragging. You know why? We were there.
We were there.
10 years ago, we were there. 10 years later, we're here. We're not newbies. We've seen the good, the bad, and the ugly. So if you want experience and everything, life experience is nothing else that can be substituted. So if you want someone who's been there, done that, like went through a depression or something, we can tell you what happened. We can tell you how gloom and doom it was, and not how bright and gloomy things are as far as what the future is concerned. The market's made a complete turnaround. 10 years ago, we're at an all-time low. Right now, we're probably, it's kind of hard to say what the all-time high is, but we're hovering around a high. Where are we going to go from here? I can't tell you, but the market's high. We've made that change. A lot of change went to the marketplace. People are buying houses. We were just talking about rents earlier today, what rents were 10 years ago, 15 years ago. Now you can't even come close to those. So as the market increases and progresses, a lot of people that waited, got priced out, can't get back in the market. I talked to a client today. He says, well, Gordon, I'm waiting in the market, the prices go down. I said, I know people have been waiting for 10 years for the prices to go down. Same thing with rates. You see something that you can afford, lock it, take it, and buy it, and move forward.
Almost 40% of homeowners in the United States are free and clear of a mortgage. That's something we've seen since the recession, the Great Recession. 25.9% of Americans at the worst, that was in the start of 2010, were underwater. That's down to 4.1% are now underwater. Home equity hit $15.8 trillion in the first quarter of this year. That's a 159% increase compared to just $6.1 trillion a decade earlier. According to Molly Boesel, the principal economist at CoreLogic, we've had years of home price growth, leaving borrowers with record levels of home equity. So if they're in a situation where they can't pay their mortgage, they would just sell. And that's something we didn't have back then. And but we also have the strength in the one thing that low interest rates does is it also gets those people who can refinance and take advantage of those lower rates, did it under the tighter guidelines. So you have these tight guidelines, and that also means they had to qualify. And the people who, in the majority of the people who bailed on their houses didn't qualify. So now you have qualified owners. You also have more equity. I just don't see it going down. Now you have low interest rates. And it's funny, you might actually see home buyers sitting on the sideline a little bit longer. We're going to talk a little bit later about how inventory is actually going up and sales are going down. So there's a little bit more inventory, but it's still suppressed. I even talked to a realtor today who said that, homes are sitting on the market a little bit longer, but days on the market as an indicator is still very low compared to its average. We are going to continue seeing some sort of push in the market, and we're going to see people might even sit back and watch to see if rates even drop further, and then that demand will come later once rates start going up and saying we need to get in, we need to get in. So I think we still have some room to grow.
Well, as I mentioned earlier, we saw the good, the bad, the ugly. The ugly was our business had gotten ugly 10 years ago. We were doing things that we should not have been doing, and the market paid the price for it. Now, as recovery come in through legislation changes in plan, we talk about qualified mortgages. I mean, you actually have to qualify for mortgage. Prices have gone up, of course, but we weeded out a lot of people that should not have been in the marketplace. A lot of people sat on the sidelines because when things are going down, people like to stay dormant. It's only when things start rising, all of a sudden there's a mad rush to get qualified, mad rush to buy, mad rush to lock the rate, because people are always looking for that pendulum to get that thing at the bottom of the swing rather than trying to ride the highs and lows. So you just said something interesting. 40%.
As I always do, right?
As you always do. 40% of people have homes that are free and clear. That's an interesting stat simply because our Americans are very, very low on savings. So are they not saving money? They're putting money into the house to pay these houses off. Is that a strategy for investment? Since your biggest investment is in your home, is in real estate. So is that what we're doing with our money? Rather than saving it, we're paying down mortgages. Never thought about that. We have to look into that.
Could be one thing that we're doing, and I'm not saying that people are. I have a lot more confidence knowing that. I mean, I have a house that's almost free and clear, one of them, and another one that I have equity that I've seen rising. And
so there you go, bragging.
I'm bragging again. So it's 37% of households are free and clear. That's up 5.5% in the last 10 years. In general, according to Javier Vivas over at Realtor.com, in general, higher home equity is financially preferable, and the rise in mortgage-free home ownership is in line with brighter economic conditions, which is why we've seen the free and clear share increase over the last decade. I don't know if it's we're putting our eggs in the wrong bucket. I'm just happy to see that we are having a bucket fill up, in my opinion. Then we can start getting picky. I think that's where it's going to where we should start figuring out what to do here. If it is a high, do we start thinking about consolidating and allocations and retirement? We have a huge pool of baby boomers that are getting ready to sell and retire and figure out where they're going to end up. And my parents just did this. They sold their house. They bought it at a high, and they sold it at a high. They also sold the other house that they moved to at a high. So they did pretty well with how they worked out. But we're going to see a lot more people doing this. So we do believe that there's going to be a lot of another phase in what I call this reshuffling of money.
Well, timing is very, very important, of course. If you're a seller right now, I mean, you're throwing all aces, right? Because the market's high, you're getting your price point that you want. If the deal falls through, there's another buyer in line to buy the property. The key thing, what do you do with that cash? Your parents are very, very fortunate that they were to sell it to high of one of the highs at the marketplace and be able to roll that money to something else into a nice retirement age. So that was a good plan on their behalf. So kudos to them. We got to brag about them.
We'll come back after this break here on AM 1220. I am Tony Mendez. That's Gordon Hines. This is the Real Estate Report. You're always welcome to shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We have good information on our website, BayAreaLoanSource.com. We'll come right back here on AM 1220 KDOW. This is the Real Estate Report with Tony and Gordon.
Questions about real estate? Call the program 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show 800-516-1220, 800-516-1220. California Bay Area home sales declined 4.7% year over year in the second quarter 2019, and inventory is up 11% year over year as well.
So when they say year over year, they mean the same quarter, the same time frame last year?
Yes. So compared to last year, so 11% higher in inventory.
In the second quarter.
The high-end, though, home prices over $2 billion have done very well.
Over $2 million or $2 billion?
Over $2. Did I say billion?
You said billion.
I think I was kind of coughing at the same time.
Okay, so $2 million.
$2 million, and then everything under $1 million. So the $1 million to $2 million kind of slowed down.
Okay.
Which is interesting because I always thought based on my calculations and my experience, dealing with a lot of the buyers and sellers in that range, I have 1.4, 1.5 is kind of the affordable range. And it sounds kind of silly, especially if you've moved to the Bay Area recently.
Depends on what part of the country you are. Right?
What part of the country you're listening to us in. But yeah, 1.4, 1.5, based on a 20% down on a property at current rates with a good credit score, not a lot of debt, and a dual income in the Bay Area. That affords that kind of price.
Wow.
So I'm surprised to see that range is really suffering as opposed to we know that everybody wants affordable housing. Do you see that playing into some of the, how do I say this politically correct, challenged areas in the Bay Area? Do you think that at some point we're going to see some of these areas revitalized because people are going to spend more money on these? We've seen San Leandro and Oakland make massive changes and transformations over the last several years. Do you think that's going to continue as we see home prices go up, or do you think that it's just going to kind of squeeze other neighborhoods and make them worse? And I don't know. Tell me the dynamics that you've seen happening.
I mean, the way I see it is, regardless of what city you're in, anytime you have blight, the only solution for blight is money. So if you want that neighborhood, you bring in money, you bring in new people, you bring in employment, you bring in jobs, those neighborhoods start to change. Unfortunately, when those neighborhoods start to change, the people that were there, the blighted, end up getting, extracted or displaced. That's where the uproar starts. But the blight can't. The blighted people can't stay there because it's the new people that are coming in that's bringing the influx of cash and bringing the renovations to the property, looking at the glass as half full, where the blighted people there for a long time looked at it as half empty, and people don't realize the economics of that formula. So a lot of times we talk about displacement, we talk about gentrification, but the gentrification has to happen because in order to change that blight, you have to bring in new blood almost, and that's what happens in those neighborhoods. Unfortunately, that's what happens.
Do you see this? Do you see the sellers or the owners basically saying, "Well, yeah, I can see the money, but I don't. It's not enough. It's just going to put me in another blighted area, and I just can't sell." Even though it is that affordable, very affordable range in some cases where, you have plenty of buyers looking for that.
Well, a lot of times I don't think people think about that.
And then they won't sell.
You're struggling to a house, can't maintain it, and somebody comes in and offers you a number you can never imagine. I don't think most people don't think about where am I going to move to. Most people just focus on the cash. When they focus on the cash, they sell the house, and then a lot of times they realize they made a mistake. But they can't go back and repurchase the house. But the dangling of the carrot, the dangling of the cash, caused them to make a rampant decision. And later on, sometimes a lot of people end up regretting the decision to sell. That's
a question. A lot of people who are selling, they have a home. We've talked to clients all the time where they are kind of stuck in their house. They can't duplicate their scenario. In fact, a lot of people can't even duplicate their scenario as far as qualifying, because their down payment is all tied into the house, and if they sell it, and they want to improve their situation, it doesn't help their numbers. They're still spending more money on the loan, and they barely even qualify for the house they own.
Well, that's what we always say. If you can afford, in this marketplace right now, if you can afford to purchase the house that you're living in at current value,
that's a pretty darn good situation.
You're doing actually pretty well. There's a client that called today, had two houses that he's been asking me to look at the comp for the last year. So he told me he made his final decision, he wants to sell, and I just asked him a few questions. Why are you selling? Are the properties not paid for? Are they not cash flowing? Do you need the money? And he just said he's just tired. I said, what are you tired of? They're rental properties. Somebody's paying for it. So that's when you kind of make bad decisions, because he's strictly focused on the cash. And I said, if you have a specific use for the cash, then consider selling. But if you don't have a specific use for it, if you sell that property and put that cash to the bank, it's going to get used up in a year later. You won't have the asset.
And then you wish you had
the cash. It's going to be gone.
Yeah. And we see that, unfortunately, we see that often, but a lot of people already have a plan. We're working with a client right now who knows they're going to be leaving in 5 years. They're leaving in 5 years, and they're making a decision to refinance into an ARM just to get that lower rate. I mean, there's some decisions that people can make that can improve their situation, but emotions, try to keep them out of the equation. We'll come back after this break here on AM 1220 KDOW. This is the Real Estate Report.
Phone lines are open on The Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into The Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can call the show 800-516-1220, 800-516-1220.
Or send me an email.
What's your email?
Gordon.
Gordon at Bay Area Loan Source. He's like, send me an email, and he just look at, what do you want me to say it?
Yes.
You can say your email.
It's your turn.
All right, Tony at BayAreaLoanSource.com.
Gordon at BayAreaLoanSource.com.
Millennial homeowners in 2019 are less likely to take extraordinary, is it extraordinary or extraordinary?
Extraordinary.
Yeah, I know. Measures to afford their mortgage payments, such as getting help from their parents or co-ownership. 51% of millennial home buyers indicate plans to use one or more of these strategies to cover their mortgage payments. That's down from 60% last year. So millennials are getting a little upper hand that they didn't have over the last several years. That's good to know that we're seeing quite a bit of an improvement, about 17% overall, saying that they're not needing help.
Well, we talked about that the other day on the show where I was talking about that mortgage solicitation I got in the mail. As a matter of fact, a client calling me about that 2 weeks ago, saying they got the same solicitation where these companies now would advance you cash, right? No appraisal, no nothing, just an equity share. And at the end of the day, they're going to sign an agreement with you that whenever you sell, they're going to get X amount of your equity. So, I mean, there's all kinds of, wherever there's a dark cloud, there's a silver lining, all kind of opportunities. And if you're in a rut, it might sound good, but remember, you're selling your soul to the devil later on. Yeah,
there's definitely some contribution from organizations like that. I personally would not get in. If I was going to get some sort of assistance, I wouldn't do it that way. I wouldn't do equity share. I don't think a lot of people would do that, but you are kind of doing that if you do it with a co-owner. The amount of millennials that are using a co-owner that's not a spouse or a family member is decreasing as well. So we're just seeing that group. It's the largest buyer group out there that we've ever had. And it's good news to hear that they're making some ground in the ways that they qualify. But we're also seeing, them moving to different parts of the United States where there is affordable housing. And we're seeing, we still haven't figured out which one is the egg or the chicken or, which one went first, but the jobs are moving there as well. Is it because there's more millennials? Probably. Is it because they have good schools there and good infrastructure? Probably. And then everything kind of fits together. And there's places all across the United States. We've seen Texas, Austin, San Antonio. We've seen places like Reno do very well. Sacramento is doing well. Raleigh, North Carolina, and then all these other little places. We saw like Ashland, North Carolina, or is it South Carolina? North Carolina. All these places are doing really well. Because Richmond, Virginia, then I think Suffolk and Norfolk and places like that, because there is this big, they're like, oh, I can't afford a house here in Washington, D.C., and they're going to move to a place like that. So millennials, it's good to see that. I think we need to embrace as an industry, realtors, mortgage companies, and it goes down the line from there.
Well, that's the same form I mentioned earlier. Once the money comes to the table, jobs is a very important factor. Jobs is what pay salaries. Salaries is what pay mortgages. So anytime you have a place that's offering jobs, that means there's offering money. People are going to go where the money is. And once they go where the money is, they're going to start to be able to buy houses. Like Las Vegas, for example. Las Vegas is booming because of that particular situation. Now, I told you hit that I-15. You think you're in California. They have new housing tracts on all sides of the freeway. Varying in prices from $150,000 to $600,000.
We don't know what that means. Varying prices.
Varying in home prices.
You saw what happened in D.C., right?
So you can pick your opportunity wherever you want to be and be in Vegas because there's a lot of money there, a lot of job there, and there goes the opportunity.
What do you think about how Amazon is moving into Northern Virginia and home prices are up 17% since the announcement of them moving up? So they already were higher home prices. Now they're 17% higher and inventory is starting to lack considerably. So we could see that number even go higher. But again, they're bringing in thousands of jobs.
And they're bringing in not thousands
high-paying jobs.
High-paying jobs, not low jobs or like with the stadiums that we talked about before. They don't bring in seasonal employment. They're bringing good paying employment.
We'll come back after this break here on AM 1220. You're welcome to call the show, 800-516-1220, or email any of your scenarios to info@BayAreaLoanSource.com. That's info@BayAreaLoanSource.com. We'll come right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Good old Peter Gabriel. It's an interesting video. You look back.
Whatever happened to Peter Gabriel?
He's still around somewhere.
Okay.
Not dead, as far as I know. You can correct me. 800-516-1220. We got some emails. You can always email the show, Tony@BayAreaLoanSource.com, Gordon@BayAreaLoanSource.com, or info@BayAreaLoanSource.com. I'll give you plenty of choices, whatever your preference is. This is from Juan and Maria in American Canyon. We bought our house 4 years ago. We're planning on selling our house in about 5 years after our kids finish school. We have equity in the house, and we're thinking of pulling out some of that equity to make upgrades to the house before we sell it. What is the best way to do this? Now, I think this is kind of a two-part question. Should they put upgrades in their house if they're going to sell it in 5 years? Now, based on today's market, things are selling, but not as fast as they used to. I know American Canyon. I think I might do the upgrades, Gordon. What do you think?
Well, probably
just to get that, get a little bit of extra attention. It might be another house that has the upgrades right next door selling for the same price.
Well, just the timeline. If you put an upgrade 4 years from now, it's not an upgrade, right? It's probably just an improvement. So that's the biggest difference. What do they plan on doing? Are they talking about remodeling the kitchen? Are they remodeling the bathroom? Are they adding a new garage door? Are they doing some exterior painting? Are they doing landscaping? Those are all the kind of questions you have to know to kind of give a person advice in which direction they want to go. There's much money you can spend on a house as far as improvements. There are some improvements have a better return on investment than others.
There's a good chance they don't even get dollar for dollar on this, right? So why do the improvements? And where I live, it doesn't matter if you make improvements on your house or not. It's going to sell for top dollar, which, you do the TLC, a little bit of paint, maybe rugs.
So there you are bragging a bit. Where you live, every house sells, whether the dump or not. Okay.
Is this the bragging day?
Bragging Thursday.
No. I'm actually not known to be a bragger. I'm well known to not be a bragger.
Doing a good job at it.
Some of the best ways to pull out the money. Well, you can do a total refinance where you pull the money out. You can do an equity line, or you can do a combination of the both. We've seen, we've talked about how equity lines are rates are higher than today's rates if you get a refinance, and possibly even lower than the rate that you have on your current loan, the first loan that is. So a lot of people are refinancing out of the equity lines, but that doesn't mean an equity line doesn't work for you. The great thing about an equity line is you only make payments on the balance that you borrow. So let's say they need that money. In this case, over 5 years, they're going to renovate their house or improve their house. Maybe they don't borrow the money all at once. And if you do a total refinance, you're paying interest on that money right away. Where an equity line, they can pull out 10 now, 10 next year, 10 next year, 10 next year, 10 next year, and that's $50,000, and you're done. And then you're making the payments slowly over time. So that could be a consideration. You could also do a first and second where you refinance the first to maybe improve your cash flow situation on the first. Remember, you're going to be out of there in 5 years. Maybe you do the lowest rate possible out there, and then get a second loan, which we do, by the way. They're first and second combos.
One of the other suggestions that's very creative that they could possibly look at it, if they know they're going to be out of the house in 5 years, what they can do is invest in the house by paying accelerated payments towards paying down the mortgage, which is actually going to give them a return on investment. When they sell the property, they're going to net more cash. A lot of different things you can do. The greatest thing is these people, just like a lot of people you have to call the show or email us, have options. So that's the greatest thing in life, to have options, because you have different variations, what you can and can't do. You just got to find out the one that works best for you, and that's why they're emailing us.
Again, it's all about your Aaron. Appreciate the email. That's Juan and Maria in American Canyon. Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. This one comes from Steve. Recently bought an investment property in Sacramento with 20% down. The house cash flows and is in somewhat decent condition, but I could get better rents with about $25,000 in repairs, painting, a new kitchen, so on. I don't have the money for this, and I don't think I can get the cash out since I only put 20% down on a refinance. What options do I have? So we always we've talked about this before. We haven't talked about it lately, but Fannie Mae Home Style is a renovation loan, and you can use that on an investment property as long as it's a single family house or single unit. It could be condo, it could be anything. So you can use a renovation loan, and they can go up to what is it, 85% or 90%, and they can use the future value of the property after it is renovated. That's one way to do it.
It depends on what part of the city he's in. If he's in if economically challenged area, a lot of the cities have fix-up monies available that have no payments due over a period of time, that he can probably get one of those fix-up loans to invest in the property and then later on defer that and be successful at that too. So it depends on what part of the city he's at. If it's a low-income area, you might be able to do something like that since it's a non-owner property.
I mean, I like the whole, I can get better rents. It sounds like wants to keep it for a long time. He just bought it, wants to keep it for a longer period of time. I think what happened is it sounds like he bought it with the expectations of getting the higher rent, but then when he started looking at tenants started looking at it, and he never really got it to hit, so it started dropping the rent, and now he's looking for the extra money. His management company or whatever said, you need to improve the property a little bit.
Well, what he needs to do is also take into consideration what the rent control laws are, because that's a very, very important when it comes to the economics of maintaining rental properties. You got to look at every city now is enacting some type of rent control. Well, I think if we go to a statewide rent control, I think in January it was 7%. So improvements of rents, how much can he improve his rent by, how much money he's going to spend, what's the return on investments, what's the repayment period. Those are all the things you got to consider if you're looking to invest in something to get a higher return on investment. And
also, I mean, the renovation loan might work as well because rates have come down in the last year. Let's say he bought it a year ago. You could easily see, maybe a half a point in a decreased rate. That might help him, even if he can only raise the rent 7%. So again, these are some scenarios. I don't think you're going to get an equity line on an investment property. Besides, you'll be lucky to get something over 80%. Remember, he only put 20% down. But you also have those non-QM loans, the non-qualified mortgage loans for investor programs where if his rents cover the PITI, principal, interest, taxes, and insurance, it's an automatic qualification, but the rate's a little bit higher. We don't talk enough about that product, do we?
It's a great product. It's called a DSR, debt service ratio. Once again, if the rents are $2,000 and your PITI is $2,000, you can actually qualify without the income influx.
Without any income.
Program, as long as you meet the minimum credit score. Everything we do in life has a minimum credit score. We're credit score driven. We call it the Bible, so that's very important to maintain your credit score because it pays dividends.
I like that program. We just used that not too long ago for someone down in Santa Barbara because even though the rate was a little bit higher, the credit score wasn't great. They needed they actually took cash out. You can actually take cash out to a pretty decent percentage, and they were able because they're doing some permit stuff on their lot next door. It's a great program for investors. Keep that in your pocket. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez. You can call the show 800-516-1220.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
I'm not where I'm supposed to be. I hope that you're missing me, because it makes me feel young.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
We're talking everything as much as we can about real estate, mortgages, buying, selling, refinancing, renovations. We had a couple emails from Juan and Maria, and this one was in American Canyon. Steve and Danville, we appreciate the emails. You can always email the show, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Little story, I ran across this story, and it's about real estate commissions. It's the number one issue from sellers. They say that nearly 43% of consumers say that the agent's commission is too high. And there's the other gripes are too much paperwork, 39%. The process can take too long, 36%. It's too confusing, 28%. Too many people are involved, 21%, and giving away too much information. I don't understand that one too much, but 30% of consumers say there's nothing wrong with the home buying process. So 43% say they don't like the commissions, and 30% say everything's peachy keen. What do you think of that 43% that's saying that commissions are too high?
Well, those are bean counters. If you're a bean counter, everything is too high. $1 is too high. Some people just want taxation without representation. They want services but don't want to pay for it. That's the difference between Nordstrom's and JCPenney's, right? You go into Nordstrom's, you buy a belt for $10. You go to JCPenney, buy the same belt for $2. But it's the service that what you're paying for at Nordstrom's. So same thing in real estate. I think the services are important. The quality agent's important. You pay for the service that you get, and the more you pay for, the better service typically you're going to get. So that's how I see it.
So then you have a company like Redfin that comes in and says, we're going to give you the same service. In fact, good service for 1%. So where does Redfin fit in? Do you think 43% of those people are going to say that commission is still too high because they're bean counters?
Well, economically, you cannot get service for 1%. You really can't. Something has to give, because if you, let's say, for example, you're doing 1% services, you're going to get a lot of business. You don't have enough people to service that business, not enough money in the kitty to pay other people. And that's what people don't realize sometimes. When you have to give better service, you have to have a staff. You have to have an assistant. You want to have somebody man the phones, and that's where your money goes. Most of that money doesn't just go in the agent's pocket, and he stacks it up. He has to share it by building a team. You can get more listings by it when you have teams. So those 1%ers, that's the way into the marketplace. You look at Hyundai, Kia, they enter the market. Honda.
Don't rag on my Kia, please.
They enter the market with low price products, but as they got their foothold and they start to increase their products, you'll see Redfin increase their sales as soon as they start to get a foothold in the marketplace.
So yeah, I see the we just sold my parents' house in Reno. In fact, I did a 24-hour trip just recently. For those who are trying to get in touch with me, that's where I was at. And that realtor he earned every cent of that 3% commission. I mean, I think it actually came out to 2.5, but every cent of it, with an estate sale, with the with organizing the cleaners, with the repairs that were done on the house. Getting everything timed and moved. I mean, that doesn't include all the professionalism, the paperwork, all the the legalese that goes along with protecting the seller and representing that seller to the buyer and vice versa.
And he probably couldn't do that. Had he had 10 listings by himself, he probably couldn't do it. So he has a team that helps him out to help be more professional. Any high price item, like you go to a big law firm, they have assistants on the top of assistants. How you get good service, how you get things done. That's how you become efficient.
I asked you earlier, and I'm not sure how it ties in a little bit, but the MLS, I think they're being sued or looked at by the Department of Justice about price fixing commissions with the realtors that use it. We're going to talk about that story. I think that might develop into an interesting story.
Well, commissions are negotiable, so how do we have price fixing? Well, commissions were not
because they're steering people. Because other realtors that are looking at MLS it's listing the actual commission. And if it's less than the 3% that they want, they're not steering They're steering clients away from that one because they know they're not going to make as much. So it's a very interesting concept that there possibly could be some price fixing there in that way. We're going to come back next week. Thanks for listening. You're welcome to go to our website, BayAreaLoanSource.com, or email us, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. Thanks for being with us. We'll see you next week here on AM 1220.